Hey, Professor Mike. What are we learning today?
Hey team, welcome back. It's Professor Mike. And today we're going to be talking about analyzing business transactions. In fact, we're even going to do a little example at the end to get you started. So first of all, we need to think about what is a business transaction? Now, we've already covered the accounting equation, assets equals liabilities plus equity. And we also covered that accounting identifies, records, and communicates the economic events of a business, right? So we put those two things together and we say, okay, well, if the accounting equation always has to equal, then when a business transaction happens, it must affect one or more parts of the accounting equation. Is it making it go up? Is it making it go down? How does it affect it? And each transaction is going to have a dual effect or more on the equation. Sometimes we have assets going up and down. Sometimes we have all three. And it really depends on the transaction. So when we're trying to think through analyzing these business transactions, we really want to ask ourselves three questions. Number one, is this a business transaction? Now, there might be things that are important to a business, like a contract or, a plan that they have for the future, but it might not be a transaction. And we're going to take a look at this in a little bit when we do our example. We also need to ask ourselves, which accounts are being affected? So, is it a business transaction? And if so, which accounts are being affected? So, is it affecting cash or equipment or long-term debt or owner's capital? Lots of different accounts could be affected. And then finally, we ask ourselves, are they going up or down? And to do this, the best way to do this is to do it. So let's get right into it and let's practice. I'm going to hop out of frame and we'll go ahead and analyze these transactions together. So the first transaction we're going to be taking a look at is the owner invests $15,000 cash in their computer business and names it SoftBite. So remember, first question, is this a business transaction? Sure feels like it is. Second question, which accounts are being affected? Well, they've invested cash in the business, so probably cash, I would think. And since the owner's investing it, it's going to affect the owner's capital account. Next up, the company purchases some computer equipment for $7,000 in cash. Again, we see that word cash. So first, is this a business transaction? Absolutely. Which accounts are being affected? Well, cash is one of them, right? And what other account? Well, it's computer equipment, so we could call it computer equipment or equipment. And that final question, are they going up or down? Now, in the first transaction, $15,000 in cash, cash went up. Owner's equity went up. Those two accounts were going up. In this case, equipment and cash are both assets. So if one's going up, the other has to be going down. It's going down for real. Never mind. So cash is actually going to be going down because we're giving cash and we're receiving computer equipment. Computer equipment is going to be going up. Third transaction. SoftBite purchases supplies that will last several months for $1,600 on account. Now this has some new words that we haven't seen yet. We're seeing this on account and we're trying to figure out what several months means. But first of all, is this a business transaction? It sure is. So yes, it's a business transaction. Which accounts are being affected? Well, they're not paying cash. We've got this on account word. And what that's telling us is it's an account and we haven't paid it yet. So it's payable. It's an account that's payable. So the account's going to be accounts payable. Yeah, I heard you say it. I heard you say it right through YouTube. Way to go. Yes, accounts payable. And what's the other account that's going to be affected? The other account is going to be supplies. Now supplies, we're receiving supplies. So supplies is going to go up. And accounts payable, it's a liability. And it's going to go up as well. Instead of giving cash, we're giving a promise. We're promising to pay. And in the future, we're going to have to pay that, or at least we ought to. The next transaction, SoftBite receives from customers $1,200 cash for programming services it has provided. Business transaction? I heard you say it. Absolutely, yes. Totally a business transaction. Which accounts are being affected? Well, they receive cash, so cash has to be affected, right? But it's provided services. And in a business, what do we call it when we do the thing that our business was designed to do? Well, we call it revenue, right? That's the whole point of the business. We want to earn revenue so we can make a profit. So we've got cash being affected. Is cash going up or down? It's going up because we've received cash. And revenue. Is revenue going up or down? Revenue's going up. It's an equity account, so equity's going up as well. Next transaction, SoftBite receives a bill for advertising for $250, which it pays at a later date. So it's receiving a bill. We're assuming that it's received the advertising. So is it a business transaction? Yes. Which accounts are being affected? Well, probably advertising expense. Okay, so that's an income statement account, which ends up on the equity side of the accounting equation. And it's not going to pay right now, it's going to pay later. It's an account that's payable later, probably an account payable. Yeah, I heard you say that one as well. So absolutely, it's going to be an accounts payable. Accounts payable is a liability. It's going to go up on the one side of the accounting equation, and equity is going to go down because expenses decrease equity. Next up, SoftBite provides $3,500 of programming services and receives payment of $1,500. Here's a tricky one. Now, let's start with our first question. Nice and easy. Is this a business transaction? Absolutely. Right? Totally a business transaction. But which accounts are being affected? And to this point, we've only seen 2 accounts being affected in a transaction. And I told you earlier on that we can affect several accounts. And this is a good example of an entry that affects more than 2 accounts. So they provide $3,500 of programming services. So revenue is going to be affected, right? Because they did the thing that the business does. They receive payment, that means cash, of $1,500. So cash is going to be affected. So revenue's gone up by $3,500. Cash has gone up by $1,500. What are we missing here? There's about $2,000 that we're missing. So that $2,000 is an account that is receivable to us, and we're going to call that an account receivable. Again, I could hear you right through the computer screen. It's an account receivable. Of course it is. Well done. So the 3 accounts that are being affected are revenue, accounts receivable, and cash. Revenue's going up. Accounts receivable and cash, both assets, are also both going up. Next up, the company paid some expenses in cash. They paid rent, salaries, and utilities. Now, is this a business transaction? Yes. Which accounts are being affected? Well, if they paid in cash, probably going to be cash. Yeah, okay, so we got cash, rent expense, salaries expense, and utilities expense. Those 3 expenses are going to decrease our equity by increasing our expenses, and our cash is going down as well. So our assets are going to go down, and our equity is going to go down. Next up, SoftBite pays its outstanding advertising bill of $250 in cash. So that was the bill that they had owed before. It was payable. Now it's paid. So they're going to pay it in cash, which means cash is going to go down. But what else is going to go down? Well, we had an account that was payable. Once it's paid, we should probably get rid of that. And that's what we do. So accounts payable is also going to go down. Cash goes down and accounts payable goes down. Next up, SoftBite receives $600 in cash from customers already billed. So they already billed the customers, which means those accounts were receivable, and now they've received them. So if they get cash, is cash going to go up or down? Well, first of all, is it a business transaction? Yes. Which accounts are being affected? Cash and, I heard you say it, accounts receivable? Absolutely, because they were already billed. If we receive some of the receivable should go down. So an asset, cash, goes up, and an asset, accounts receivable, is going to go down. Next up, this is a tricky one. Signed a contract to rent equipment next year. Now, is this important? Absolutely. Is it legally binding? Certainly. But is it a business transaction for accounting purposes? No. We would want to note this. So people who are reading our financial statements would want to know that we had this contract signed, but it doesn't need to be recorded in our system. So it fails the first test and we move on. Finally, SoftByte's owner withdraws $1,300 for his personal use. So if you take money out of the company, you're taking cash out of the company, cash is going to go down, right? It's a business transaction, cash is going down. What other account is being affected? Well, it's the owner, and he's withdrawing money from the company. So the account that's going to be affected is owner's withdrawals. Cash is going to go down. That's an asset, which means either a liability or an equity has to go down so the accounting equation can remain in balance. And indeed, owner's equity goes down by $1,300, and we're back in balance. Well, I hope going through this example really helped you. I know we did it a bit quick, but it's a video, so you can pause it, go back, and watch it again. Have a great day. Bye.